Okay, so options basic terminology overview. So a call gives you the right, not the obligation, to buy a stock at the strike price before expiration. So strike and expiration are in the future terminology overview here, but real quick, what that would essentially mean is that if I had a $200 call on Apple and Apple was $300 at the time, I could exercise that call to get 100 shares of Apple for $200 per share. So it would be $20,000, even though those 100 shares were worth $30,000. So if I exercised that call, I would get the shares at 200 per share, and then I could sell them at 300 per share if you wanted to, or you could just hold them at 300 per share. But the point is that's where you'd get exercised at. And you can exercise that option anytime before expiration. I'd say 99.9% of options do not ever get exercised, period. So that's just how the game goes. And then a put is just the opposite. It gives you the right, not the obligation. So the fact that terminology is right, not obligation, is saying that premium is all the money that you're out of when you buy options. So if you're buying a call or buying a put, the only money that you're risking is the price of that call or that put. So that's why I'm buying the right. There's no obligation in that right to sell a stock at a certain price before expiration. So let's just say Microsoft is, or let's use the Apple one again so we stay focused here. Let's say Apple is $300 right now and I have a $400 put. That means I have the right to sell Apple for $400 even though it's only worth $300. So because of the difference between the strike and where it's at the time is $100, essentially I'm making $100 per share on that put. Like we've kind of been using already though, the strike is the price at which you have that right to either buy or sell the stock, which is called the underlying often. If you ever heard me say the underlying, I'm talking about the stock. The expiration is the date at which the contract expires. So after that date, the contract is totally worthless. There's nothing you can do with it. And so if you have a call, let's say it was an Apple call and it was a $350 Apple call, but Apple was $300 when the call expired, then it's probably worthless on the date of expiration and pretty close to worthless on the days leading up to expiration because there's simply not a good probability that in that amount of time the price of Apple is going to go over the strike price of that call. So that's where the expiration comes in. The premium is just what you're paying. So there's in the money premium and out of the money premium. So if it's in the money, like let's say Apple is $310 and we buy a $300 call for $1,200, $1,000 of that is in the money. So it's intricate value. My dog is moaning behind me, so sorry if you hear that. Come here, Maya. Quit moaning. Whining for me. But the premium is essentially the price that you pay. I guess I'll probably go through all this stuff here. There we go. Go back to where I was. Naked just means you look really nice. No, naked means that you're selling the option without owning shares. So if you might have heard the term covered call, if you're selling a covered call, it's because you own 100 shares and you're selling someone else the right to buy those shares. That would not be a naked option. But if I sold a call without holding any stock of the underlying, that would be a naked call, which is very risky. That would be a way of basically going short at a certain strike. Credit, so naked and credit both have to do more with selling options than buying options, which is a different side of the same coin that we can get into in the future, but it helps have a good knowledge of just basic buying and selling of options with premium, not naked options first. Those get high, it says high risk in red right there for a reason. So credit would be money you receive from selling an option. So I could sell a Apple put option, a $200 put, which I'm selling someone else the right to sell me Apple at $200, and the premium I collected for that would be the credit. Debit, on the other hand, would be the opposite. If I'm buying a put, that debit would be the amount of money I paid or was withdrawn. And then spreads are when you have multi-legs. So if you like buy a $300 call and sell a $310 call on Apple, that would be a debit spread. If you buy a $300 put and sell a $290 put, that would be a debit put spread. So it just depends what type of strategy you want to utilize. The spread aspect isn't necessary, but it's something I'm sure we'll get into eventually. I'll just flick through these here. So, quick overview: calls gives you the right, not the obligation, to buy 100 shares of a stock at the strike price before expiration. You use a call when you expect it to rise, or you buy a call when you expect it to rise. And if the stock stays above that strike at expiration, your call has value. Now, we will rarely hold a call until expiration, unless you're in my zero DTE stuff, in which case we will often hold calls till expiration. And then puts, same thing, just the opposite way. So a put gives you the right, not the obligation, to sell the shares at a set price, 100 shares. Options are always for 100 shares. And if the stock goes down, you typically make money. It gets a little bit more hairy than that. The bear hair gets more hairy than that. When you start dealing with the Greeks and how far out of the money, it doesn't necessarily mean if it goes down you'll always make money, but usually. We'll leave it at that for now. So when to use each: if you're just buying them naked, you're going to buy calls, usually near the money, in the money, near the money if you're with us. If you're looking for a short-term reversal, pop, something of that nature, reversion. And buy puts if you're expecting it to drop. It's really that simple. As long as we're going at the money, in the money, it's that simple. You don't have to worry too much about the Greeks and all that good stuff. At the money, in the money. Other strategies, more sophistication can come into play, but we want to keep this as simple as possible and as straightforward as possible when we start. Here's a few of the other strategies that'll get a little bit more complex. If you ever hear us talking about covered calls, protective puts, cash secured puts, things of that nature are more of hedging and strategies to utilize to win both directions, or to win a little less to be safer type things, but nothing you have to worry about now. Like I said, I'm going to leave that here. Go back a couple. This is really what matters that we need to get down today, is just this basic terminology overview. If you can read this and know this, you don't have to fully understand it, because a lot of the understanding will just come with practice. But just read this, know this, and you'll have a good starting point.